All right, welcome back. If you are in DeFi, yielding or using DeFi liquidity pools, you have to understand the correlation game. Okay, this is a bit more advanced, but at the same time, stupidly simple. But people tend to miss these things. Okay, so the correlation game in DeFi. Every single time you deposit into a liquidity pool, you are making, let's say, like a bet, right? Not on a price direction, but on the relationship between two assets. So if those two assets in your pool are moving in sync, you earn the fees and barely lose anything to the impermanent loss. But if they diverge, impermanent loss can eat into your position and wipe weeks and even months of fee income. Okay, so this relationship, so to speak, has a name, correlation, right? And understanding correlation game is the difference between building a portfolio that survives market cycles when it comes to yield and the one that bleeds out the first time certain volatility hits. Okay, so the spectrum of this whole correlation thing. Not all the pools carry the same correlation risk. They sit on a spectrum. So when you have pools like pegged pairs, for example, USDC versus USDT, or ETH versus staked ETH, right? Or wrapped ETH, or CBBTC, so also wrapped BTC versus VBTC, which is another version of wrapped BTC. So these are like a pegged pairs, same asset class, just on a different chain or different type of wrap or something like that. So these assets will always have a correlation very close to 1. They all move in sync. So the impermanent low risk in this case is near 0, but the fee potential is also low, right? Because if you provide liquidity to USDC, USDT pools, well, someone may swap, the volumes may even be high, but because there is no price action in that case, nothing changes, or the whole capital is always in range, earning the fees, so the fees will be low. And if we look at, let's say, VFAT in this case, and we write USDT, USDC maybe, like something like that, as you can see, we have multiple options. Of course, we have to choose the like higher TVL type of stuff. And for example, we have Uniswap on ETH, ERC20, USDC versus USDT. As you can see, the APR is basically non-existent. You can get way more by lending stablecoins out, right? So in this case, pretty much this whole TVL will be working actively and earning those fees. But because this is such a highly correlated, lowest possible risk asset, it's just there's no point into holding these things. You could extract a bit more from stablecoins, but definitely it's not the main idea. It could be the safest possible way to enter DeFi, but even that just does not make sense. It's then easier to just lend your stablecoins. Of course, you can choose different stablecoins and find, maybe better opportunities. USDT versus DAI can give you a bit of a better APIs, so to speak. And there are many options. Do we have anything Pi USD? Yeah, we have some stuff, but the TVL is definitely not the highest. So stable coins can give you a very safe entry to DeFi, but very minimal returns. So maybe for some people it makes sense. In this case, for us, it does not make sense, but it's safe, right? Then we have another type of assets that are within the same ecosystem, so to speak. So for example, Bitcoin versus ETH, ETH versus Arbitrum, ETH versus Optimism, etc., etc. Same ecosystem assets, right? Layer 1 versus layer 2, so to speak, okay? So in this case, if you have ETH and Arbitrum, and because Arbitrum is part of ETH, right? It's layer 1 versus layer 2. In this case, in most cases, their correlation will be much higher than average, right? So this will be between zero 0.6 to 0.8 on casual standard market conditions. So the impermanent loss risk, is average as well, and the fee potential is also average. So you can definitely make some nice income, nice cash flow using these type of pools. But at the same time, because they are fairly highly correlated, above 0.5 to the upper side in correlation, the returns will not be the greatest, let me say that. And we can actually go ahead and check if Arbitrum, for example. So as you can see, we have multiple options available. In this case, we have ETH versus ARB on Uniswap on Arbitrum itself. We have 2.3 million TVL, and it generated approximately 27k in fees over the last 7 days accumulated, right? So even though in this case it seems like the average APR is pretty high and you have pretty much 98%, in reality you should make approximately half of what you see in all of those platforms, because the way it works, it always takes historical data and creates an expected APR, so to speak, based on historical volumes. So even if you have like 1 or 2 days super actively and super high volume, it will boost the whole average of the whole month or even the year, for example, just by having a good few days. Maybe something happened, some glitch, some twitch, maybe someone came in with a massive volume, swapped some assets and left. And this will boost the whole expectations as well. So whatever you see across all the dexes, across all the platforms, as an expected yield, expected APR, the best case is to expect half of it. So in this case, this would be, well, towards 40-50% APR. Still under, well, it kind of makes sense. I wouldn't expect that much, but it kind of makes sense. It depends, of course, on the volumes of the pool. But in this case, this is actually a pretty active pool. You have wrapped ETH versus ARB on Uniswap, and it's a pretty active pool. So out of all of these options, this of course would be the most important one, the biggest TVL, the most amount of fees, the most amount of volume. The average range across users is about 22%. So with this range right here, this gives you approximately 100% APR. In reality, this would be close to 50, 40, 50, maybe 60, depending if the volumes are actually sustained and pretty high. And of course, keep in mind, under these conditions, you are exposed, depending on your deposit ratio, to both volatile assets, ETH and Arbitrum. So in this case, even though the impermanent loss risk, specifically impermanent loss risk, is lower than having ETH USDC, but directional risk exposure is higher, because if ETH is dropping down, Arbitrum will drop down as well, and you will be losing capital faster, way faster, right? Or vice versa, of course. So sometimes under neutral to bullish market conditions, such pools are amazing. But if the regime switches quickly and you fail to catch and reposition yourself, exit the pools, then you can bleed really fast and really heavy, okay? And stay in a drawdown for a long time. But it's an option, and it's definitely same ecosystem. Assets can have a very close correlation as well. And then you have the cross assets, like ETH USDC, for example, right, is one of my favorite pools, etc. But they have the lowest correlation, because ETH and dollar, they move independently at all, right? Same as BTC USDC, or for example Solana versus ETH. as well. Two completely different assets, right? So under neutral to bullish market conditions, their correlation is pretty much non-existent. I mean, ETH can go up massively, SOL can go up a bit. ETH can go up, SOL can go actually down. It does not correlate that heavily. So the impermanent loss risk is the highest, but also the fee potential is the highest as well, because there is loads of volatility, loads of directional bias across people, which creates loads of a trading environment as well, high volumes, which the higher the volume, the more the fees we get. All right. So I just explained you actually all of these things, but then you have to understand that the correlation is not a fixed number. It's always changing, it's dynamic. So correlation shifts with the market regime. That's the most important thing. In a risk-on, bullish market environment, crypto assets move independently. ETH can rally heavily while Bitcoin consolidates, or Bitcoin can rally while the rest of the market stays flat, then Bitcoin consolidates, and then different assets starts to rally. Solana can pump while ETH is flat. All coins can rotate, meme coins, narratives, all of that stuff happens independently, right? Yes, the consensus, the general consensus will be up, but timing can differ heavily. Bitcoin can go up for this week, then a few weeks flat, but then ETH or some altcoins can go up 10x. It's independent under the bull market conditions. So the correlation between major pairs drops to 0.3 to 0.4. So this is the environment where your medium correlation pool behaves exactly as you expected. Fee income is healthy, impermanent loss is moderate, and everything works. So for example, under these conditions, stuff like ETH Arbitrum, Optimism, etc. Would give you the best possible returns because, well, it's moving up aggressively or at least neutral. So if ETH is going up, most likely Arbitrum can have some upside as well, or at least remain flat, or vice versa. So this will minimize the impermanent loss risk and also increase the fee income, right? So under the risk-on environment, assets move independently. ETH pumps, Bitcoin consolidates, alls rotate, your pool works as designed. In a risk-off environment, the crash, Bitcoin, ETH, alts, everything drops in sync. So then when a risk-off event hits, then suddenly every crypto asset dumps in lockstep, in sync. Bitcoin, ETH, Solana, altcoin, Ripple, whatever it may be, all drops at the same time, right? Even assets that has nothing to do with each other fundamentally, everything goes down when crypto and let's say Bitcoin starts to go down, right? So this is a very funny situation, so to speak, right? When everything is neutral or bullish, everything is moving independently, capital rotates into different niches, smaller sub-niches, etc. The consensus is beautiful. But when shit hits the fan and everything reverses, everything drops in sync. When crypto drops, there are no hedges, pretty much. Of course, some exceptional cases happens when everything is going down. Some meme coins, some random bullshit stuff might actually go up, but within the biggest market cap games, so to speak, there are no hedges. When crypto goes down, it's going down and everything is going down. So then the correlation between all the pools becomes massively higher and can spike up to 0.85 or even higher. So then your medium correlation pools like BTC ETH that was running at 0.6 to 0.7 now behaves like 0.95 pair. And here is the problem, the biggest one in DeFi and crypto in general. The spike in correlation happens alongside a spike in volatility, right? The correlation numbers, so to speak, will not give you a signal in advance that, oh look, we are about to correlate very heavily. If volatility hits, then the prices hits right? Everything is going down, and at the same time, the correlation also increases immediately. So the price is moving further, faster in the same direction. And if both assets dump hard in sync, you are eating a very concentrated directional impermanent loss without the fee income to compensate if your range was tight, right? And because this happens because in a crash, volume is super one directional, in most cases fully selling environment, rather than back and forth trading that actually generates the LP fees. So it really depends what kind of a pool you have, whether it's a wide range or a tight range, and the whole portfolio setup, right? But in general consensus, knowing how people mindset works, right? Most people will have the highest possible APIs, pools with the smallest possible ranges. And this is the death spiral environment. There is no long-term sustainability. So you have to think about it. Think about correlation. I mean, professional DeFi is much more advanced than just a simple deployment into the pools and hoping for the best, right? Short term, sure, whatever range you choose, 5%, 10% range, small range. Short term perspective, yes, you will yield some gains. It will be beautiful, nice, and simple, right? But medium to longer term perspective, if volatility hits, there is no way to survive. Okay, there is just no way to survive without constant rebalancing or just accepting the loss and then recovering in other forms, right? So you really have to think about these things. Okay, it's not that simple, but at the same time, my goal is to at least do my best and share the knowledge to educate when it comes to DeFi. There are loads of videos online in YouTube everywhere. People showing different pools, meme coin trading, or even meme coin DeFi stuff, etc. It could be fun. It could play out. You could actually have allocations into meme coin pools as well. Those pays amazing fees. But at the same time, these cannot be your only pools or main capital pools, so to speak. If you diversify your portfolios when it comes to DeFi pools, good enough. You have some medium correlation pools, some negative or non-correlative pools, so to speak. Then yes, you can play around things. But in general, this is the core idea of this video was to show you and to teach you that correlation between pools is really, really important based on the market condition. Okay, so this is a little play stuff that basically you can see how the fee income and impermanent loss exposure moves. I just made this with AI stuff. It's really simple, but as you can see, the higher the correlation, right? So you have less impermanent loss exposure, and the smaller the correlation, then the impermanent loss exposure grows as well, right? Because those are the uncorrelated assets. They can move in both sides. Volatility is can punish you. So basically, the summary, the last sentence, right? The correlation determines your impermanent loss exposure. So your fee potential and how your position will behave when the market shifts from calm to chaotic. So the pools that look most attractive on a yield dashboard are almost always the least concentrated and correlated, which means that they carry the most impermanent loss risk during the regime shifts that matter the most. If you are fully certain that the market's gonna remain neutral or bullish, yes, you can deploy capital, of course, into riskier pools. That's the whole point, right? Making the most out of the markets. But you have to always be prepared for a regime shift as well. And always have a strategy or at least some capital ready to deploy or already deployed into the boring pools while they will be underperforming during the bull market conditions when, and not if, but when shit hits the fan and the whole regime shifts, right, and changes to negative. your most active, riskiest pool will start bleeding. You react quickly, you save yourself, but that one boring pool that you had that yielded you just a little bit during the best possible time in markets, when it becomes negative, when everything is crashing, whatever, that one simple boring pool can actually save you and yield you the most amount of yield if positioned correctly. If the whole approach and setup, range, width, allocation, everything was correct, it can actually save you, right? So that's how you should look at DeFi. Please watch all the videos in my channel. I mean, I explain everything in such detail. My vibe of these videos are really raw, simple, right? I believe that's the point of what I present, not how. I could hire 50 editors and make beautiful videos in penthouses and Lambos and Ferraris and shit, but there is no point because it's just visual entertainment, right? But zero knowledge in those videos. And I prefer high educational, valuable knowledge, but zero nonsense editing stuff, right? I mean, that's my approach. That's how I perform, and I believe it's working. Even though the views are not into, you know, thousands and stuff, but these are quality views. People are messaging me, asking questions. We are communicating. It's fun. It's fun. It's cool. So that's correlations. Hopefully it's gonna be beneficial for you. As always, wishing you all the best, and I will see you on a next video.